Scalability. Access to capital. Cooperatives may have limited access to capital markets compared to private or public companies. The cooperative model can make it challenging for organizations to rapidly scale and expand. Choosing the right ownership structure. 1. Strategic objectives. 2. Stakeholder needs. 3. Risk tolerance. 4. Access to capital. 5. Governance requirements. When selecting an ownership structure, consider factors such as your strategic goals, stakeholder priorities, risk tolerance, access to capital, and governance needs. The right model can empower your organization to thrive in a dynamic business landscape. Ownership models. Empowering organizations. Discover the key ownership structures that shape the modern business landscape. From private ventures to public institutions and cooperative models, each approach offers unique advantages and challenges. Explore the considerations in choosing the right ownership structure for your organization's success. Private ownership. Definition. A private company is owned and controlled by individual investors or a group of shareholders. Advantages. Flexibility, autonomy, and the ability to make decisions quickly. Public ownership. Definition. A public company is owned by shareholders and traded on a stock exchange. Advantages. Access to capital markets, increased transparency, and professional management. Cooperative ownership. Definition. A cooperative is owned and controlled by its members, who share in the profits and decision-making. Advantages. Democratic governance, alignment of interests, and a focus on member benefits. State ownership. Definition. State-owned enterprises are owned and controlled by the government, serving the public interest. Advantages. Ability to pursue long-term strategic goals and address social needs. Comparing ownership models. 1. Flexibility. Private ownership offers the most flexibility, while public and state-owned models are more structured. 3. Risk and reward. 2. Accountability. Public and cooperative models have higher levels of transparency and accountability to stakeholders. Private ownership carries higher risk but also the potential for greater rewards, while public and state-owned models have lower risk profiles. Advantages of private ownership. Autonomy. Private owners have the freedom to make decisions and steer the company's direction. Profit potential. Private owners can reap the full financial rewards of their company's success. Flexibility. Private companies can adapt quickly to market changes and pursue new opportunities. Simplified governance. Private companies have streamlined decision-making processes compared to public or cooperative models. Advantages of public ownership. Access to capital. Going public allows companies to raise funds through stock offerings. Talent attraction. Public companies can offer stock-based compensation to attract and retain top talent. Transparency. Public companies are subject to rigorous reporting requirements, promoting trust and accountability. Prestige. Being a publicly traded company can enhance a company's reputation and brand recognition. Challenges of cooperative ownership. Decision-making. Cooperative governance can be complex, with members having an equal say in decision-making.